Let's get some insight on how markets are shaping up at the open today. Alan Nuckman, he's the chief market strategist at Agora Financial. He joins us now. Good morning.
Good morning to you.
We have a little bit of red as we start the trading day. I understand you're looking at the number 3,200 on the S&P 500 as sort of a target that you had out there. Tell us a little bit about why that level is important.
Well, the market had gone sideways. Even though it didn't feel like it for much of 2019, it went sideways in a wide range between 2,800 and 3,000 in the S&P. And when we finally broke out of it in October, it's been 10% straight up since that time. So we moved above that 3,000 level, 3,000, that 200-point range. On top of 3,000, it turns out to be 3,200. So we've gotten to that point. But in the big picture, my technical objective is much larger, and you can say that obviously we're in a much different scenario than we were at this time last year. This is a December to remember. Last year was not so much fun. You remember that this day last year, the Dow was down more than 600 points. There was a lot of volatility. Market volatility has fallen from 36 down to 12 where it is now. So things are completely different in price action, but it seems like the news and the cycles of information are very much the same. So I love how the market's reacting differently now in 2019 than it did in 2018. So I view all this as very much a positive, and we're seeing a lot of signs of stability. My big picture target is still up above at 3,500, and that's the distance of the drop we had last December on that old top, and that's happened every time in history as far as the markets go.
Last December, of course, in retrospect, was a huge buying opportunity if you could gird yourself to buy into that abyss. As you said, flip side, is there too much positivity out there?
I don't think so. And to get back to that VIX measurement, now the VIX this year, the volatility, the fear index, did not take out the 2018 low. So even though we've drifted lower and we're down 50% in the VIX from last year, the markets aren't complacent from a mathematical standpoint. And if you look at it, we've kind of bottomed out. And even though we continue to make new highs almost every single day, we still have not taken out the April lows in the VIX. And you'd like to see that correlation. And even if they do go down to that 11 that we saw in April, we were down at 10 back in 2018. So there's still more downside in the VIX, meaning, in my opinion, there's more upside in stocks. So from where we stand right now, things are still steady and strong ahead. And let's remember, last year was difficult. Last December was difficult. But we are in a bull market. Nothing has changed. This is more than a decade long now. And with what's happening in interest rates, this is where money is going to flow in the chase for yield.
The NASDAQ is on a 9-session winning streak. I think you've indicated it's the longest since 1998. Of course, tech, and you think of the NASDAQ as tech-weighted, is certainly biotech-weighted as well. Tech and the S&P 500 up 47%. Is that a place where our viewers should concentrate?
Well, I think, obviously that's the future, is technology. And a lot of companies, even though they may be, stodgy Dow companies or whatever, the S&P companies, they have to participate in the technology growth or they get left behind. So everybody now is a technology company. Look at pizza companies. They're all about, how people can order, do things digitally, do things online, and bang, so they become technology companies. That's a key component. Now that's been the tech takeoff in 2019 has been the big story. Like I said, 47% off the lows of last December. That's been an amazing move. There's been a lot of big movers. You talked about Tesla making a huge comeback. Netflix has found some support at 300. So the theme for the season is believe. You've got to believe. And all of this happened, obviously, with the backdrop. I'm not even going to get into the backdrop of the politics and the policy and all the nonsense that's happened here in America. But this has happened against a backdrop of an earnings recession here in America. Let's remember, the last couple of quarters, we've actually had negative earnings growth. So I think for 3 quarters in a row, that hasn't happened in a long time. And the stock market continues to make new highs. Now, here in 2019, we're going to see some positive earnings. And so that could give give the market another catalyst, another jolt to the upside.
Beyond discussing the politics of Washington at the water cooler.
Nope, not going to do it.
No, I don't want you to. I don't want you to. But it is interesting that it does not seem to be affecting sentiment at all.
Exactly. We've gotten to the point now where the market has understood when the boy cries wolf. It doesn't mean anything anymore. The markets are going to do what they're going to do. And like I said, money is going to flow where it's going to get the best yield. And with treasuries at these extreme lows, there is no choice. When treasury rates get back up to 3 or 4%, maybe there is a choice and people can look. But look at the dividend yield in the S&P 500 companies. You're going to get a much better payoff than you would be putting in 10-year treasury notes. So also what's important is we're seeing so many signs of stability, and it's hard for me to say that, especially in the last 2 years that we've had. We're seeing so many signs of stability from a macro standpoint. The fact that interest rates have firmed back up, and we're getting back to close to 2% again in the 10-year. That's pretty significant after that 150 low. And we're also seeing a lot of other markets. We're seeing, as you well know, as a resource country, crude oil back above 60. That's pretty important. It traded for the longest time between 50 and 60. Now a breakout that targets 70 on the upside. And we were at 70 in 2018. So I think some of those sectors and stocks that have been forgotten offer some good opportunity, and we've seen that money flow back into the energy and some of these resource sectors. I think the key component here, the next lever that the politicians can pull to stimulate the market, and that's what they're going to do. We've all come to the realization they're going to do anything and everything, whether it breaks norms or not. We've already lowered interest rates as probably as far as we can go, but the next step is the decline of the U.S. dollar. If they can knock the U.S. dollar down, then that starts a whole nother sector. You'll see a lot of resources and commodities make a move. At the same time, I like where the Canadian dollar is holding above the 76 level. You've been in that range between, 74 and 77 for the last year. We're above the halfway point on that. 80 is not that far away, and 80 seems to be the larger overall midpoint that we've seen over the last 20 years. So I think that we could see some strength in the Canadian dollar here as well.
And just briefly going, and I love the comments out of Chicago about Canada. I love that. Just briefly, though, internationally, some of the international markets have lagged big time. Is 2020 an opportunity for maybe Chinese stocks?
A little bit. Now, if you go to the Euro Stocks Index, the Euro Stocks Index is very close to its all-time highs. So it's not just us, as we always say in the United States. It's not just us, even though we make it about us. I do have a little bit of a Canadian accent, so that's where my appreciation comes from. But you can see opportunities. China's not going away. They'll figure out a way to rebound. And yeah, you hear in the news that they're really suffering, but their GDP is still 6%, which is, I'm not good with math, but that's triple what we have in America. So, it's just a matter of time. If you look at the mathematics, if they're continuing to grow at 6% and we're growing at 2%, they're going to benefit. But like you said, I think there's some opportunities in the fact that if you look at FXI, which is the Chinese ETF, it has firmed back up and it's gotten back above the 40 level. So I think I'm a buyer of distressed stocks and sectors and ETFs and look to see how they react. But I use longer-term options so I can play 3 months, 6 months. But I think, yes, you're going to see money start to flow probably out of the hot stocks and, trying to find some opportunities. Not that they're not going to continue to go up. Tech's not going to continue to rocket. But I think from a risk-reward standpoint, you could get a sell-off at any time, like you've seen in some of these stocks in Roku and Beyond Meat and so forth and so forth. So it's about value.
Thank you very much, Alan. All the best over the holidays and next year as well.
Have a good holiday.
Alan Nuckman, he's a chief market strategist at Agora Financial.